Liquidity is a topic that confuses many new traders, not being able to understand how it helps us when trading Forex. In this video, I explain to my premium members in my community the types of liquidity in the market, how to identify them, and how to use them to your advantage when trading. Sit tight, take down notes, and let's get right into the video.
Alright, so for today's lesson, what we have here is the liquidity concepts. Now, I want to go through a few main things here. First things first, liquidity. What is liquidity? The actual definition of liquidity is basically where there is a huge money pool in order for the market to move from one place to another place. Price need liquidity to move. If the market is illiquid, there's no exchange of funds from buyers to sellers or from sellers to buyers, the market will not go anywhere. It will stay. That is what we call an illiquid market. Okay. So in the terms of SMC trading, or in the idea of trading ICT or anything related to smart money itself, liquidity is used as a way of stop loss hunting. Now, what do I mean by that? A lot of you guys here may have realized that, okay, look, when you first start out trading, you may be trading support and resistance. Okay, you have a support, you have a resistance. Okay, the color is going to be the same, but don't really matter. You guys get the idea. The idea here is that price action will create some form of a range, right? A range. Come down, come into the area, come up, like that. We have a range. So now as you can see here, there are so many equal highs. These equal highs here are where a lot of people are placing their stop losses. Like this, for example, right? Like this. So many people are just like placing their stop losses here and there, right? There's all these orders that are being stacked just right above the resistance. People are trying to sell. In this scenario, all these stop losses are basically orders in the market that are used to make sure that if in the case price goes up higher, these retail traders or these traders will have their stop loss triggered, right? So technically speaking, stop loss is a good idea, right? But here's how the market or the banks and the institution sees it. If they see a whole bunch of liquidity or orders over here, they see it as where the market can come and grab new orders from. Because you understand, an order is only closed when a stop loss is hit, when it's manually closed, or when a TP is hit. There's only an exchange of hands in the market when either you enter a position, buy, or SL gets hit, TP gets hit, or you close it manually. They're all transactions that you're doing. Okay? And each time there's a transaction, there is going to be liquidity formed, right? So in this case here, there is a lot of stop loss there that's not triggered. So what if price cannot get out of this range and price wants to continue ranging, right? And let's say price don't have volume to move. What can price do? Price can come back up and take out these price points here. Why do they want to take out these price points? Why do you think so? Correct. To have an order big enough for the banks to sell, right? Because you must understand, when all these stop losses here are triggered, they kind of stopped out, right? They're in a sell position. What do they do? What does the market do? Or how does the market work in a sense where if you're in a sell, if you want to get out of the sell, what do you have to do? You have to hedge the position. You have to get it in a buy. And this is where you get in at a buy, the seed as your entry. So for example, you enter a one lot sell here. You want to get out, might as well one not buy. That's how you get out of the trade and draw down. Exactly, zero-sum game. So in this case, when your stop loss get triggered, you get buy orders. So in the market, there are people buy here. And when the banks decides to retrace all the way down or wants to manipulate the market in a sense, these orders here fuel the liquidity so that they can place a large order after taking out all this area here to sell down lower. Because a lot of people are buyers the moment they get stopped out, right? So that's where they make sure price action continues dumping. This is called manipulation. This is how liquidity is formed. That's why liquidity sweeps are thick. Now, with that being mentioned, right, I know some of you guys may be asking, look, this explanation is a bit too complex. Very simple. Then let me just keep it as a concept in itself. Now, in trading Forex itself, there are the market moves in two main fashions. Okay, it moves from internal liquidity to external liquidity. Now, what do these mean? Internal liquidity are your POIs like your fair value gap, your order block, your go highs and equal lows. These are your internal liquidity. Price within, for example, let me give you an example. Liquidity generated within a price range. For from here to here. Any POI that is formed, for example, let's say an order block here, this is internal liquidity because price is within the internal structure. Price hasn't created a new swing high or a swing low. What is external liquidity? You have your swing high, swing low, swing high, swing low, swing high, swing low, swing high. Each time a high gets taken out, you have your external liquidity being taken out, right? So your highs and your lows are your liquidity points. There are always liquidity at this area. Why? Because there are people placing their stop losses at highs and at the lows. Simple as that. Understand that? Okay? When you have all these highs in place and lows in place, sooner or later, price will come and take out the lows, right? And that's when you have a change of character, blah, 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 right? You have a reversal of the market. But you will understand that the reason why price can come and target these lows in the first place is because there is liquidity here, right? So the market goes in a cycle. Let's say the market is taken out at an all-time high. Let's say gold, for example. Gold is taken out at an all-time high. What do price normally do after creating a new all-time high? Chat, let me know. What does price normally do after creating a new all-time high? It drops, right? Retraces. And where do people retrace? And where does the market retrace to? Normally in fair value gap, an order block, or some form of equal lows to take out some liquidity and something like that, and then potentially going up. Logical points, correct? Exactly. This is what we call internal liquidity. So price will go from external to internal to external to internal. It will keep going on and on and on. Okay. So do you guys understand this? How price will always go from swing points to areas within the range to find for liquidity to move the market. So in this case here, when price is retracing into the range from here to here, price is grabbing liquidity from a fair value gap, an order block, whatever it is. And once it grabs the liquidity from here, that liquidity will drive price to the next point of liquidity. Okay, you understand? For those guys here that are new, at every single point in price, there are people buying and selling, right? But the most obvious area where people will have their stop losses are number one, swing highs, swing lows, support, resistance. Agree? Yes or no? This is exactly why you have external liquidity at this point. So it's called, you can just think of it this way, it's labeled as external liquidity because this is where people have their stop losses, and when price takes them out, price reverses. So it's liquidity. It's generating liquidity. Very good, Understand, I can move on, Let's go through the types of liquidity. Something like this. Very nice. Okay, so let's draw this first one here. First type of liquidity, we have your double bottoms. Double bottoms. Okay, price creates double bottoms or double tops, whatever it may be. Price creates equal lows. Okay, these equal lows are basically where retail traders will look like, oh, this point here has rejected twice. So what can I do? I can place a stop loss here. So let's say they want to take buys. They place a stop loss here. So if price comes back and takes them out, they'll be triggered into a sell position because they cancel out their buy position, right? And then what does the market do? Continue going higher. It sweeps the liquidity into a potential POI that is supported by it. I'll draw it later, for example. But this is what price normally does during high volume periods. No worries, Geoffrey, you can go ahead. All right. So yes, in this case here, what we have here is considered equal highs or equal lows. So if I want to flip this around, right, I can just draw the same thing here. We can see price comes down, comes back up, takes out liquidity, continue lower. Okay, price created equal highs, thereabouts, like that, sweeps the liquidity, provides a move lower. Why? Because there are stop losses here, the stop losses here. They're very close to each other. All these are very, very strong areas of liquidity because people are placing a stop loss here. So same thing as this one here. Okay? Understand? Type 2. It's going to be swing highs and your swing lows. There was a fake out below this low, this higher low. Okay? So now once price action has created this higher low, ideally we should be looking for continuous sells. But most of the time, when you see this happens and the price continues to go up, what you want to see is for a wick candle closure below, not a body candle closure. Body candle closure most of the time will lead to a proper change of character where price continues to go lower. But if you see a wick and then an aggressive push upwards, then most of the time, this is what we call a liquidity sweep. And this liquidity sweep here is a swing low liquidity sweep. If I were to flip it around to this, invert, same thing. You will see flip, right? You see price come up and then suddenly very aggressively push downwards. This is how you know it is a liquidity sweep. So in most scenarios, how liquidity will actually look like, in most scenarios, how price action will actually form will be like this. Let me show you guys. This one doesn't look very nice, huh? Let me show you, let me draw for you something. Price comes down, pushes up. What do you see? Trend line, right? Here we have trend line liquidity. Why is this considered liquidity? Something like equal highs and lows, correct? People are placing their stop loss here because they think, look, oh no, guys, these highs and lows are respecting so nicely. Let me put my stop loss here, right? But at the same time, these highs and lows didn't do much. It didn't come and retest into a PY, like a order block, for example. So what will the banks like to do? Price can drive lower to makan all this liquidity, tap into an OB, which is also another liquidity area where price has buy orders here that are left unfulfilled, come and collect it, and then go, boom, okay? So yes, this is also considered inducement because these lows here that have been put in place didn't do anything. Didn't mitigate an FVG, didn't mitigate anything. It just created lows for no reason and basically just continue going higher slowly, showing you that there's no volume in the market. Alright, let's put it this way. Is this considered manipulation? Yes. That's how the market moves. The market manipulates from one point to another point. And how they do it is by taking out stop losses from one point so that they got enough orders to push to the other side. That's why the market never goes up in one direction. That's why the market never goes down in one direction. It goes up and down to collect orders. That's how the market moves. That's how the market stays in equilibrium. You can't have the extreme of one side. You can't have the extreme of one side in the market all the time. The market has to go from an area of premium to an area of discount, vice versa. Move from pool to pool, move from money pool to money pool. Correct, exactly. There are a lot of buy orders here. Price will move up to the area here. Collect already, they will look for sell orders. Vice versa, they will keep exchanging. So this is a bullish example where you have relative equal highs or relative equal lows as your trend line area. So this is what we call trend line liquidity. Okay, you guys understand this, type trend line liquidity inside the chat right now. Type trend line liquidity so that you understand. There are many examples that are shown of trend line liquidity being taken out. The next thing that we need to look out for is this. Let's say you have a swing position and price decides to create a change of character like this. Okay, a change of character, come up. Price takes out this high over here. Okay, price takes out this high. What do you think price will do next? Come down, right? So what is taken out over here? What is taken out over here? External liquidity or internal liquidity? What is being taken out here? External, correct? Very good. So we're expecting price to come down and test an internal level of liquidity, which could be a fair value gap or an order block. So in this case here, let's see, price comes down and retests here. This is an order block. Price generates liquidity from this order block here, generates liquidity, continue to push up higher, taking out external liquidity once again. Because this high that was created is now the new external liquidity. That's how the term draw on liquidity is or came about. Basically, where price is more than likely to aim for external liquidity. Does this make sense? Then once it does it again, it will go back to finding internal liquidity again, like a fair value gap here or an order block at this dip. You look for orders to come and collect to push up higher. Or it could do this, come down and break this low. And now when you break this low here, what do you have, ladies and gents? Okay, a change of character. Okay, correct, it is a change of character, but also, what kind of liquidity is this? You guys are confused, right? Okay, this is considered your external liquidity. Why? This is your structural low, structural high. Okay, so this is your external liquidity. And within this area here, we have FVGs, okay, whatever, breaker blocks, BB, yep, there you go, breaker block, or whatnot. Okay, so price can come back and form and find liquidity from this area here, or perhaps maybe even here, before coming lower to take out the new external liquidity. So as you can see, the market is constantly moving from internal to external liquidity. Make sense? Very, very good. Because I'm slowly learning, slowly leveling up. Now, of course, I want to show you guys some live chart examples, right? There is going to be, I think the best way to learn is going to be via live chart examples. So let's just show you right now. Let's go to Euro US dollar, right? Let's take a look at the 4-hour time frame. Just to see how price action moves, how price action forms. Okay, let's just remove all the lines here. All right. Okay. If you take a look at the 4-hour time frame itself, we can see price created a high, created a low. Okay, price created a high, created a low. So now we are in this range. Okay, so now we have our external liquidity here, external liquidity here. If the market is going to continue bearish, price action will respect the top area here and disrespect this lower end of the liquidity, the external liquidity. But as you can see, price retraced, and which part did price start to gather liquidity from? An order block. Once it found its liquidity here, filling the fair value gap as well, as seen over here, price had enough orders to drive price lower to take out the new low. Does this make sense? Yes or no? So as you can see, once price came all the way down here, we now have a swing high. Let's just remove everything. We have a low. Where's the highest point? Here. Lowest point, the price actually went down to here. So this is our move. Okay, price pushed up higher, taken out. This what? External or internal? External, alright. Right, and what does price do? Price retests an internal level of liquidity, an FVG. Came down, collected orders, pushed price higher, breaking. External or internal? External. Very good. Same thing, Now our structural low is where? Here. Right? From here to here. Price moves lower, breaks completely. Okay, breaks all these level. First level of liquidity, second level of liquidity, all broken through with this huge move down. So now we are bearish for sure. Right? And where is our swing high liquidity? We have one here. We have another high here, and then our structural lows here, right? Now, if you take a look here, price, what did price do here? Price tapped into internal liquidity, continue to break external liquidity, creating lower lows. Price tapped into internal liquidity, which is this daily fair value gap, a retrace, continue lower. And right now, the sell side here is building liquidity. Why? There is relative equal lows forming right here. If you want, you can even draw this as a trend line liquidity, whatever you want to call it, right? There's trend line liquidity. All these are sitting areas of stop losses. Double bottom, yes, correct. But you can't just rely on liquidity itself to think that, oh, okay, perhaps because there's liquidity, I can look to short. That is one thing that I see a lot of new traders do. They get too involved in where the liquidity is, and they just decide to ignore everything else, ignore structure. Oh, I see the liquidity, therefore I must short from here. No, you must incorporate it. You must incorporate it with other things. Structure, order blocks, fair value gaps, understanding of all these things. Then these areas can be used as areas to target, or an area for you to wait for a sweep before entering. Confluence, right? Same thing. If I were to go through the Asian sweep strategy with you guys already know the criteria in and out. Sweep of a high or low. Why? Because there are stop losses sitting above the Asian high and low, right? And once price sweeps that, we create a change of character. When price change of character, what happens? It goes the opposite direction, right? It means the price is more than likely to continue to reverse, right? And where can price potentially target? Another external liquidity, right? That's how the strategy comes about. Price moves from internal to external. And that's why our entry criteria for the Asian sweep strategy is that we need to wait for a change of character first. So something like this. Okay, let me just turn on the sessions. Let's find one. Okay, we have a high, we have a low. Low is all the way down here. Okay? Okay, we have a high, we have a low. Price after the Asian session, what did price do? Dipped below, created a what? 5-minute Chokchi, as seen by this line over here. Okay, so this is the Asian low. We have an Asian low. Price come and do what? Price taken out the external liquidity already. The Asian low is the external liquidity, correct? Price broke up and do what? From internal liquidity, what do we target? External liquidity, right? And what did price do? Went all the way up there. Boom. That's how this strategy works so well, because it uses the understanding that market moves from internal liquidity to external liquidity and back to internal liquidity and then back to external liquidity again. Beautiful. So now everyone is clear on the understanding of internal liquidity and external liquidity, yes or no? So now let me try to find for you an example of how liquidity looks like in terms of trend line. Okay, let's take a look here. Does this look like trend line liquidity to you or not? What did price do? Came down. Oh no, we BOS, guys. We BOS. Oh no, takes out this. You see it? You don't see it. Okay, very simple. Why is this liquidity? This is liquidity because many people are seeing this. Oh, look, it's respecting the high, respecting this high. Okay, I can place my stop loss here. Respecting this high, I can put my stop loss here. This is trend line. Understand that the psychology of the bank is to fuck with retail traders. Let's think about it that way. Psychology of the bank is to fuck with retail traders. And if people are respecting the trend line, right? If price is respecting the trend line, a lot of their stop losses will be placed there, right? Stop loss place here, place here, place here, place here, place here. What's price going to do? Take it out in the future, right? And what did price do? Price created a move lower here, tricking people into thinking, oh look, what my sales are going well, my stop loss is here, it's fine, it's safe. I can look to sell, I can look to continue selling. And what did price do? Reject off, close as a wick, take out this liquidity here, right? This swing low liquidity, pump up higher, taking out this liquidity here, and even higher prices. It pumps with this displacement as well. And what did price do? Right, take out liquidity. So now you can see if we swing low, now we swing high. What did price do? Come back test, internal liquidity. Is this considered internal liquidity? I would say this is considered internal liquidity. Trend liquidity is considered internal liquidity. Swing points like this are considered external. Low, high, low. This is just chopping around. So when you have trend liquidity, is normally internal liquidity. External liquidity is basically your strong points. Your strong swing high and swing low. Make sense? Okay, very good. Okay, so now let me show you another example of how price action can basically do or generate liquidity to create an order to tap into a high probability POI before buying or selling. Let me show you. Okay, let me show you guys. Now, if you take a look here, let me see if I can squint my eyes to see. Look for the example. Let's take a look at gold. Okay, very good example here. What did price do here? Show you, play. Price action has done this. Okay, price action has done this. We have a swing high, we have a low. Price created a change of character. Fair enough. Right? This is a change of character here. This is our external liquidity. If price wants to continue lower, price should continue to push up higher, retest an OB or an area of internal liquidity that hasn't been tested before. OB. Price retested this, respected it with a body candle close within the OB itself and dumped. So as you can see here, price went from clearing the external liquidity, which is the structural low, creating a change of character, coming in to clear the internal liquidity, which is this, and tapping into an OB, which is also considered internal liquidity. And this generated enough orders, enough sell orders in the market to move price lower to take out our external sell side liquidity. Does that make sense? So that's why if I see slow price action here, more than likely I won't be looking for sells here. If I see relative equals high here, I won't be looking for sells here, because I know that there are stop losses above this area, and I know that the price will look to take out all these people. If you take a look at where price is now on gold, let's do some live reading using liquidity and see how we can look at the market right now. You can see 15-minute time frame. Do you consider this liquidity or not on a lower time frame? I drew this just now on live stream. Yes? Internal liquidity, correct, right? Exactly. Good. What did price do? Take out external liquidity. Boom. Wick. This was the last low that created this high. Where's our external liquidity this day? Here. So once price take out this external liquidity, price is looking for internal liquidity for price to continue to move lower or potentially come up to take out the external liquidity above here. Will I buy at this level? No. What I would do is wait. Okay, if on hindsight what I would do here is wait for this level here to come out. Once this level here breaks, what I would do is wait for this level here to break. This confirms to me with a body candle close that price action will continue going bullish. So I will look for an area of internal liquidity, like an FVG, for example, or an order block here to enter longs. Why would I not look to long from here? Any body candle close? No. So this is why I wait for a body candle close here after sweeping the low one more time, push up higher with a body candle close to confirm, and then for price to retrace into it, tap into this order block here to continue to go higher, to target potential external liquidity. We have one right here. We have another one right here. All these are targets for price to go and hit if price want to continue bullish. Okay, so this was a change of character. Now we have created a BOS. So let me just label it so that you guys are not confused. This is how it looks like. And all this thing here is considered liquidity. That's why price ran so nicely. I can even extend it up to this area here if I want to. It looks like it's respecting the line very nicely. Alright, so you guys understand, yeah? So like I mentioned, price sweeps the low. This low here is the external liquidity. Price takes it out, push up, breaks the internal level of liquidity, right? Taking out all this level here as well. And it gives us a confluence by giving us a body candle close above. Does that? Retraces, push up higher, gives us an entry criteria here. If you want to enter from here, can, potential, risky. Just risky only. Now I understood why you have a few layers of protection. Exactly. That's why. You have what I'm doing here is having multiple layers of internal liquidity to act as my areas for price to come and collect orders. That's why drawdown is inevitable sometimes. Because price to come back and collect orders to continue to push up higher. Just like gold yesterday. Gold came down to collect liquidity before going higher. I can still see in gold, see the structure. Yeah, very good. This lesson is awesome. Why not enter when external liquidity is collected? Because at that point of time, Sharon, you are actually calling the top or calling the bottom, which you shouldn't be doing. You can look to target the external liquidities, but you don't want to enter from external liquidity. That is risky. Alright, okay, so that is it for the lesson, ladies and gentlemen. I hope you guys enjoyed it.
That's it for the Liquidity Mastery Crash Course, teaching you how to use liquidity to your advantage and avoiding potential losses in your trading. I hope you have gained value from this video. Make sure to implement whatever that you have learned into the charts. If you want to be a part of the Zooms and ask questions in real time, be a part of a community of 1,800 members learning and earning every single day. Then go ahead and click the link down in the description below to join our Telegram group where we share our analysis, trade updates, and stream reminders on a daily basis. I'll see you guys in the next one.